When you look across today's financial landscape, the signals are not subtle anymore. They're loud, synchronized, and impossible for any rational investor to ignore. We are at the edge of a structural shift, the kind that redefines winners and punishes complacency. People assume markets move gradually, but the truth is, inflection points arrive suddenly. They catch the world off guard, and by the time the majority reacts, valuations have already evaporated. That's why today is not about what you should accumulate, it's about what you must offload before the next wave of volatility hits with full force. We're seeing bubbles inflating where fundamentals simply cannot justify the momentum. Overstretched balance sheets, leveraged positions, and speculative mania are forming the same patterns we saw before every major correction of the past 2 decades. And while innovation will remain the most powerful wealth generator of our era, not all assets participate in that long-term exponential curve. Some holdings become dead weight, slowing your portfolio down just when you need agility and liquidity the most. This is why the first category to reconsider is highly leveraged tech stocks. Investors have poured billions into companies with unproven models, prioritizing rumors and momentum over execution. As borrowing costs normalize, these firms face brutal margin compression. And when a correction comes, speculative tech collapses faster than any other class. We've seen that movie many times. Next, illiquid equities and private placements. When markets turn, liquidity becomes the most valuable commodity. But illiquid assets are impossible to exit at fair prices in periods of stress. They trap capital, and in risk-off environments, trapped capital is lost opportunity, sometimes lost permanently. Then we have overconcentrated thematic ETF, particularly those built around hype cycles. When sectors get overcrowded, every new dollar has diminishing impact. These ETF often become crowded exits during downturns, amplifying the sell-off. Investors holding these products rarely realize how fragile the underlying structure becomes at peak valuations. Another area that demands caution is high-volatility crypto assets. While blockchain has incredible long-term potential, many tokens still trade on speculation alone. With regulatory tightening expected across multiple regions, the next sell-off could be deeper and more chaotic than previous cycles. When liquidity dries up in crypto, recovery takes much longer than investors anticipate. Penny stocks, meme stocks, and small cap speculations form another category. Retail-driven mania can create impressive short-term gains, but the downside is catastrophic. When sentiment turns, these assets fall 70–90% with shocking speed because they were never anchored in real fundamentals. The exit doors are tiny, and everyone tries to run through them at once. We also need to talk about corporate bonds from highly indebted issuers. Rising refinancing costs are putting enormous pressure on weaker companies. The bond market is already showing stress lines, and when yields spike, these instruments lose value quickly. Many investors underestimate how sensitive junk bonds are to even mild economic turbulence. Real estate in overheated markets is another area where risk is quietly building. Demographic shifts, high interest rates, and declining commercial occupancy create structural headwinds not easily reversed. Holding property in markets already flashing red is a liability, not a hedge. And finally, speculative commodities and non-functional digital assets instruments driven purely by sentiment, not demand. When fear spreads, sentiment evaporates first. The message is simple: the world is transitioning. We are moving from an era of cheap capital and indiscriminate risks, taking to one where only assets backed by innovation, resilience, and genuine value will survive. This is not about fear, this is about repositioning. It's about stepping away from fragility and leaning into strength. If you want to thrive in the next market cycle, you must shed the assets that no longer align with the world that's coming. The danger ahead is real, but so is the opportunity for those bold enough to prepare today. The most dangerous moment for any investor is not when markets are falling, it's when they appear calm, predictable, almost invincible. That illusion of stability is always the final phase before disruption strikes. And today, the signals forming across global markets are unmistakable. They're telling us something critical. 2025 will not reward complacency. The system is shifting, valuations are stretched beyond reason, and several asset classes are flashing red at the exact same time. If you're not preparing now, you may be forced to react later, and reacting in a panic-driven market is where wealth disappears. The first category demanding attention is overleveraged technology stocks that rode the AI wave without delivering true innovation. Many of these companies raised massive capital during the era of cheap money, but their business models remain unproven. They are burning cash, not generating it. When the market reprices risk in 2025, and it will, these companies will face valuations collapsing faster than management teams can issue their next guidance revision. Next, investors must look at thematic ETF tied too tightly to single concepts, especially those built on hype rather than real scalability. These ETF boom when markets are euphoric, but transform into exit traps when sentiment reverses. Their diversification is an illusion. Once the underlying theme cools, the entire structure unwinds violently. History has already shown how quickly thematic baskets can lose 50-70% of their value when too many investors crowd into the same narrative. Another area that requires decisive action is junk bonds and corporate debt from heavily indebted companies. Rising refinancing costs are reshaping corporate survival odds. Many firms that looked stable in 2023 and 2024 are now staring at debt walls they cannot overcome. If rates remain sticky or recessionary pressure builds, these bonds could face a dramatic repricing. Investors holding them will be caught in a downward spiral of downgrades, defaults, and evaporating liquidity. The fourth group involves illiquid assets, including certain private equity stakes and speculative real estate investments. These are the last assets you want in a downturn. They trap capital at precisely the moment you need flexibility. Your ability to reposition in 2025 may depend not on what you own, but on how quickly you can exit it, and illiquid holdings offer no such freedom. Let's address speculative cryptocurrencies and low-utility tokens as well. While blockchain technology holds exceptional long-term promise, the majority of tokens in circulation today will not survive regulatory clarity or risk-off markets. These digital assets trade on momentum, not adoption. And when momentum breaks, they don't correct gently, they collapse. The same applies to penny stocks and retail-driven meme plays, which rely on optimism rather than fundamentals. These assets are the first to crash in any fear-driven environment because they're built entirely on sentiment. When markets lose confidence, sentiment evaporates faster than liquidity. Overvalued luxury, real estate markets face their own headwinds. Structural changes in demographics, shifting work habits, and affordability constraints are colliding. The correction already underway in several regions is just the beginning. Holding inflated property in late cycle conditions exposes investors to unnecessary downside. Another fragile category is commodities tied to slowing industrial demand. As global economic momentum softens, oversupply becomes a risk. Investors holding commodities purely as inflation hedges without evaluating real demand cycles are exposing themselves to sharp reversals. Finally, we must acknowledge legacy companies resisting technological transformation. Markets reward disruption and punish stagnation. Companies unwilling or unable to adapt to new frameworks in AI, automation, robotics, and digital platforms will lose relevance faster than investors expect. The message is straightforward. The world is transitioning into a new financial era defined by innovation, efficiency, and adaptability. Many traditional assets will struggle, and several speculative ones will not survive the turbulence ahead. The crash warning for 2025 isn't about fear, it's about clarity. It's about recognizing that certain holdings no longer align with where the global economy is heading. If investors make disciplined decisions now, they won't just protect their capital, they'll position themselves for the extraordinary opportunities that always rise from periods of disruption. There are moments in financial history when the environment shifts so suddenly, so decisively, that the worst mistake an investor can make is standing still. Right now, global markets are entering one of those rare turning points. The signals are aligning in a way we have not seen in over a decade. Stretched valuations, tightening liquidity, rising defaults, geopolitical instability, and a technological revolution reshaping the hierarchy of winners and losers. This is not the time to cling to weak assets out of habit or hope. This is the moment to protect capital, increase resilience, and pivot into strength. Some investments are becoming liabilities, and if they remain in your portfolio, they will drag you into the kind of losses that take years to recover from. The first category to exit is hide, at companies with collapsing margins. These firms thrived when money was cheap, but cheap money is gone. Their refinancing costs have exploded, their earnings are shrinking, and their balance sheets are no longer sustainable. As rates normalize, leverage becomes lethal. These companies will face rating downgrades, rising default risk, and, in many cases, accelerated decline. Next, consider shedding overcrowded speculative tech, the companies that surged on narratives but failed to build durable revenue models. A transformation is happening in technology where only mission-critical innovation will survive the tightening environment. Companies relying on hype, not execution, will be exposed. When markets pull back, the most inflated valuations deflate first, and they deflate violently. Then we have meme stocks and retail-driven small caps, which are dangerously disconnected from fundamentals. Hope, excitement, and online culture pushed these stocks far beyond their real value. But hope is not a strategy, and sentiment-driven assets are the first to collapse when fear enters the market. They offer tremendous upside during euphoria, but devastating losses during corrections, and corrections do not arrive politely. Another high-risk area is illiquid alternative assets. When markets become uncertain, liquidity becomes king, but private placements, non-transparent funds, and investments with long lockups trap capital. In a downturn, illiquidity does not just limit flexibility, it magnifies risk. Investors cannot reposition quickly, cannot exit, and often cannot even mark their assets properly. That is a recipe for hidden losses. It's also time to reevaluate junk bonds and high-yield corporate debt. As economic conditions soften, we're seeing higher delinquencies and rising refinancing stress. Companies that barely survived the last rate cycle may not survive the next one. When high yield cracks, it cracks fast, leaving investors with steep losses and limited buyers. Another critical area to reassess is speculative cryptocurrencies. Not the foundational blockchain projects with real adoption, but the thousands of tokens with no utility, no network effects, and no long-term viability. These tokens move purely on momentum, and momentum collapses instantly in risk-off conditions. Regulatory scrutiny is rising worldwide, and many speculative digital assets will simply not survive 2025. We also need to address overheated real estate markets, especially in regions where prices grew far faster than incomes or demand. Structural changes in work patterns, affordability limits, and rising carrying costs are creating cracks in property markets that once felt invincible. Holding inflated assets into a correction is one of the costliest decisions an investor can make. Weak commodity plays tied to slowing industrial cycles also face headwinds. As global growth moderates, oversupply becomes a real threat. Commodities that appeared safe during inflationary surges can quickly turn into loss makers when demand shifts. Finally, traditional businesses failing to adopt AI, automation, and digital transformation face existential risk. Markets are now rewarding innovation and punishing stagnation. Companies refusing to evolve are effectively choosing irrelevance. The world is not collapsing, it's transforming, but transformation demands clarity. Dumping the wrong investments now is not panic, it's discipline. It's positioning yourself for the opportunities that always follow disruption. The next era of growth belongs to those who move first, think boldly, and refuse to protect outdated assumptions at the expense of future returns. What we're seeing in the markets right now is the type of setup that only appears before major reversals. It's subtle at first, slower growth here, weakening liquidity there, but then it forms a pattern that tells you the prevailing narrative is about to break, and when narratives break, assets that once looked untouchable can implode almost overnight. Protecting your capital isn't about reacting to the crash after it hits, it's about recognizing the tremors before the earthquake. Right now, those tremors are everywhere. The first area of vulnerability lies in companies overloaded with debt. These are firms that survived the last few years not because their models were strong, but because borrowing was cheap. Today, refinancing is becoming a crisis point. Their interest payments are ballooning, margins are tightening, and earnings are deteriorating. A slight economic slowdown will push many into distress, and their stockholders will absorb the losses. Next, we must talk about overvalued growth stocks with no path to profitability. The market rewarded these companies during the liquidity boom, but that environment is gone. In 2025, investors are demanding real earnings, real customers, and real utility. The companies that cannot deliver those metrics will see their valuations corrected sharply and decisively. We also need to consider the danger in stagnant legacy businesses that have ignored the technological revolution reshaping every industry. AI, robotics, automation, and digital platforms are not optional shifts. They are survival necessities. Companies refusing to evolve are being left behind structurally, not temporarily. Their decline will not be cyclical, it will be permanent. Then there's the risk tied to speculative crypto tokens and non-utility coins. While transformative technologies continue advancing, many low-utility digital assets remain propped up solely by momentum traders. These tokens have no adoption, no revenue, no competitive moat. When volatility spikes, their value doesn't adjust downward, it collapses entirely. The next regulatory wave will expose just how fragile these assets are. Another asset class nearing the tipping point is junk bonds and weak corporate debt. With global default rates rising and refinancing pressures mounting, these instruments are one economic shock away from severe repricing. Investors seeking yield often underestimate the true risk these bonds carry until the yield spreads explode, and by then it is far too late to exit. We should also address overheated real estate markets, particularly those where prices have far outpaced incomes or demographic demand. Housing does not move in a straight line, it corrects in waves, and right now, the combination of slower demand, higher financing costs, and structural shifts in where people choose to live is setting the stage for a meaningful correction. Another fragile sector is commodities tied directly to weakening industrial activity. As manufacturing slows and inventories rise, commodities once viewed as inflation hedges can quickly transition into oversupply situations. When demand evaporates, prices follow with remarkable speed. On top of that, we have the growing issue of illiquid investments, from private placements to niche alternative funds. Investors underestimate the risk of being unable to exit. In volatile markets, illiquidity is not just inconvenient, it is destructive. You cannot reposition, you cannot hedge, and you cannot access your capital when you need it most. Highly speculative small cap stocks also pose enormous danger. These companies depend heavily on sentiment and retail enthusiasm, but sentiment is evaporating and the liquidity supporting these names is drying up. When institutional money steps back, small caps lose their buyers instantly. And finally, we must acknowledge the vulnerability in assets built entirely on hype cycles, the kind that rise because people believe they'll keep rising, not because the underlying economics justify their price. These are always the first to collapse when confidence shifts. The world is entering a new financial cycle, one that will reward clarity, discipline, and forward-thinking strategies. Protecting your money now is not about fear. It's about recognizing that the market is shedding its weakest links. Those who reposition early will not only avoid losses, they'll be perfectly positioned to capture the extraordinary opportunities that always emerge after a correction.